Hi guys, this is Mr. Tan, and today we're looking at financial appraisal systems and looking at how we would appraise a project based on payback, net present value, or the accounting rate of return. And we're saying to ourselves, well, if we've got a pot of money in the company and we've got different projects, how do we know which project we should be investing our money in and where are we going to get the best return? So for that, we're going to look at an example, and we're going to look at three methods in terms of payback period, the net present value, and the accounting rate of return. And in the example here, we have three potential projects, projects A, B, and C, with the initial investments for each being 80,000, 150,000, and 80,000. And then over the next 4 years, you have year 1, 2, 3, and 4 with estimated cash flows for each project. And then the total cash flow at the end for project A is 160,000 with an 80,000 pound investment. Project B, 225,000 pounds with a 150,000 pound investment, and project C, 125,000 pounds with an 80,000 pound investment. So the question really is, how do we know which project to go for? Well, the first method we're going to look at is payback period. And the payback period, we're saying, how long does it take to get your money back? And this example here, if we look at project C, the initial investment is 80,000, and in the first year is 40,000, second year 40,000. So it takes 2 years for project C for you to recuperate your money. Project B, it's 150,000, and in the first year you have 30,000, second year 45,000, and the third year 75,000. So it takes 3 years to recuperate your money. And then if we look at project A, well, project A is initial investment of £80,000, and we can see that in year 1 and year 2 it's £35,000 each, so it's a total of £70,000. But in year 3 you have £40,000. So how long does it take? So here you divide the £40,000 by 12 months to work out, how much you're going to get estimated for each month. And then if you work that out, we can say that you're going to get 10,000 in 3 months added to the 70,000. So therefore you recuperate your money of investment of 80,000 for project A. So it takes 2 years, 3 months. If we look at the three projects, then project C is the quickest project to get your money back, 2 years, followed by project A, 2 years, 3 months, and then project B, which is 3 years. So, here, if we use this period, then we would have selected project C. Now, if we look at the next technique, which is the net present value, with this technique, we're saying, well, what's the true worth of the value of your investment over the period of time? And here we take a discounted rate. So if we selected 10%, then the 10% you would take a discounted factor of value, which would be provided in a standard template in a table. So if you took 9%, you would get year 1 discounted rate, year 2 discounted rate, and year 3. So in this instance, we're looking at a net present value. We say we wanted a return of 10%. So 10% discounted in year 1. So the total revenue would be times 0.909. Year 2 would be times 0.826. Year 3 times 0.751, and year 4 times 0.683. And these discounted rates are actually provided in a table depending upon the discount rate which you select. And then for each of the cash flows in each year at that discount rate, you multiply it, which gives you a figure. So for example, we look at product A, cash flow is 35,000 times a discounted rate in year 1, 0.909, which comes to 31,815. In year 2, there's a cash flow of 35,000, but the discount rate is obviously going to be lower now. It's 0.826, which gives you 28,910. And then in year 3, it's a 40,000 pound cash flow times the discounted rate of 0.751, which gives you 30,040. And then a cash flow of 50,000 in year 4 at a discounted rate of 0.683, giving you a true value worth of 34,150. And if you add up all these cash flows in terms of their true value and true worth, it comes to 124,915 minus the initial investment of £80,000. So you're actually true worth is 44,915. And if we apply this same technique to project B and project C, multiplying the discount rates, which are going to be the same discount rates for year 1, 2, 3 and 4, by the cash flow, then project B, after you've taken out the initial investment of 150,000, comes to 21,990, and project C comes to 21,495. So ultimately, if we were going to use the net present value to determine which project was the most profitable from a 10% net present value rate, then project A would be the front runner, followed by project B and then project C. The next technique that we're going to be looking at is the accounting rate of return. And this is the percentage of return that it is expected from an investment or asset compared to the initial cost of investment. So typically AR is used to make capital budgeting decisions. So in this instance, we can see for project A, you have a total value of cash over the 4 years of 160,000. So you divide that by the number of years, which is 4 years, which gives you an average of 40,000 per year. And then you divide that by the initial investment, which is 0.5, times it by 100, which gives you 50%. And then if we calculate the same for project B and project C, then we can see that we divided 225,000 by 4 years, which comes to 56,250, divided by the initial investment of 150,000 gives you 0.375, times it by 100 gives you 37.5%, and likewise you do the same for project C. And here again we can see that project A is the front runner, netting 50%. If we compare the overall three techniques of the payback, net present value and accounting rate of return, for me, even though project A or product A loses out in terms of the payback period being 3 months longer than a project C, but it has a higher net present value at 10%, and it has a higher accounting rate of return at 50% than the other two. And therefore for me, if I was looking at this, I would be selecting project A to go with, based on using the accounting rate of return, net present value, and even the payback wasn't as advantageous as the product C. When we look at some of the advantages and disadvantages of these, we can see that the payback period is the most simplistic out of the three to actually calculate. But the disadvantage of payback is that it doesn't take into consideration the time period of money. If we look at the net present value, well, the net present value is quite straightforward to calculate. It uses cash flows rather than net earnings, and it provides an unambiguous measure. Some of the disadvantages are it assumes that you can accurately assess the cash flows over the period of the 4 years, and also it assumes that the net present value rate stays the same over the lifetime. So that in itself is not crystal clear. If we look at the accounting rate of return, we can see that this suffers from the same disadvantage as the payback period, in that the biggest drawback is it doesn't take into consideration the time period of money, and that the money as we see today may not be the same value as in 4 or 5 years time. It would have decreased. But the advantages of ARR is that calculating it is relatively easy, and the rate of return is easy. Managers can quickly see whether an investment opportunity may be lucrative enough to justify doing further evaluation. So again, if we look at these, we can see, returning to the example, purchasing new machinery to increase productivity. If the initial calculation shows the purchase will only garner a 2% increase in profits, but investing in trucks to deliver products to the customers will reduce the shipping cost by 10%, then management should decide the reduced shipping costs would be a better investment.